Hey all, welcome back. Want to share some of the lessons I learned from watching the Bigger Pockets podcast with Barbara Corcoran. And the messages and the lessons were so compelling that I wanted to make a video and share them with you. And if you haven't had a chance and you find what I share interesting and helpful, I highly recommend you go and find the actual podcast on Bigger Pockets. So here's what Barbara Cochran's formula for real estate investing is, and then some of the other things I learned from her. So the first thing she says is you should buy in up and coming areas. So she says the biggest gain by doing this is that she found out by talking to waiters and other folks who have their finger on the pulse where they were living, and then she went and drove those areas. She would also make sure that she drove the areas during the day and also at night to get a better feel for an area. So she talked about how um, folks usually move, the folks who usually have their finger on the pulse will move in first. And then, so she talked about, for example, and this sounds a bit stereotypical, but I'm sharing what she shared, that gays usually move in first to these cool areas, then families. And so sometimes she says she found areas where she would look at the trees and the trees were just so beautiful that she knew that it would be up and coming. And she tries to tap into areas where there's a feeling of youthfulness um, and maybe areas where folks who have less cash right now um, are moving into, because these are the up and coming areas. And I think the upshoot or the upside of this approach is it allows you then to find really good assets that you can buy that are relatively lower in price or costs to the other areas that are already established. So that made a lot of sense to me. Second thing she talked about in her formula is then she would find a 10% partner. And so this person would be an equity partner and they would stay an equity partner until she sold. So in her approach to real estate investing, she does believe in holding, but from time to time she would sell. She says that the partner that she would look for is someone who knows the area very well. So therefore, they will be the one to help the partnership, and especially her, find the best properties. So she says focus on the area first, and then focus on the areas and the partners first, and not the units, which was quite eye-opening. She says your partner should help you find the best. Yeah, I've already mentioned that. So the idea here is you have a formula and a discipline that allows you to always find the area, so location, and then once you find the area, the partnership helps you to identify the right asset to buy. The third part of her formula is overpay. And she speaks about being comfortable paying 10% more to, and then especially if paying 10% or even more will help her to get the asset off the table. And she says you more than make up for that 10% premium. And she cited Harry Helmsley as giving her this tip. Fourth thing she spoke about, she says you have to have your own property managers. Yeah. And then next thing she spoke about, fifth thing, was she says, because she had money, but yeah, okay. She says that her approach worked because she actually had money, but not time. And for many of us starting out in real estate or wanting to go big in real estate when we start, it's the opposite. We have time, but not the money. So like for myself, like, don't really have as much time. Definitely don't have the money yet, but it's definitely the flip of her where she has the money, she has the time. Maybe if I was able to save some of that $1,854,169 I paid in taxes between 2016 and 2021, I would have some of that money. But that's why I'm so driven about these taxes, y'all. Okay, let me continue. So sixth thing. Um, Oh, she says don't only look at one way of making money. She says there are 10 ways of making money in real estate, but she didn't elaborate, so I'm going to do some digging to figure out like according to her. Oh, actually no, sorry. So she didn't say there are 10 ways. Bigger Pockets says there are 10 ways, and I do remember seeing a video in the early stages of me trying to learn about this real estate game. But I need to actually go back and look at that video, and I wasn't in the practice of taking notes like I am now from those episodes that I've watched. But yeah, I have to recall what the 10 are. So sorry, I don't remember what they are right now, but there are 10 ways to make money in real estate. I mean, I can guess, but I don't want to belabor the point. Maybe I'll make a video once I recall or run into that information again. Okay. Um, Number seven, how much of a mortgage can I slam on the property? These were her words. So she really looks at what what debt can the property support, and that's based on the cash flows from the property. So if you have tenants or you have rented it out and you have other ways of making income with the property, then that's going to determine how much debt you can put on it. And there are all kinds of rules of thumbs and formulas. Like Grant Cardone, for example, would say, okay, he would take the NOI and multiply it by 1.25, and that would tell him like how much debt can the property support or sustain. And he has a whole logic around it that perhaps we'll talk about in another video. Okay, so that was number seven. Number eight, ooh, I love this. Number eight was the money tip. She says the minute she can refinance and pull money out of the property, she does it. So she believes very much in leverage, and she says that there's a particular property that she owns that she's remortgaged maybe 10 times. And it was a 5-story, 8-unit building that she bought. She's been able to remodel, to remortgage that 10 times. And this is the beauty of real estate, y'all. This is what gets me so excited about real estate. When you have an asset and you own that asset, you are able, once the income is sufficient, to refinance it. And because of the tax code, when you refinance it, that money is not taxable in your hand because it's still debt. So once you refinance, because you have tenants in the property, the tenants keep paying, and once they've paid it down to a certain amount, or once the debt reaches a certain percentage, you can refinance again and again and again and again and again. So literally, you can pull money out, tax-free money, of a property that you own over and over and over again. And this is where concepts like infinite returns enter, where once you've actually paid back or taken out what you put into the property, anything that you take out from that point on is infinite. The return is infinite because you have no more money invested that you haven't paid back. So whether that's money to you or to your investors. So love that. Number 9, she says that she bought a property in Manhattan for $120,000. She will never sell that building. So you gotta imagine that this is one of those properties that she's probably owned for 3 decades plus, because she's been in the game and dominating the game in New York for some time, right? So for those of us who are starting out now, I mean, 120, it would be hard to find something for 120 in most cities in the US, or in most major cities in the US. Definitely New York is probably out of the question, but you can use it as a metaphor. Like, what is your $120,000 property that you can find that you keep in your portfolio and that it keeps making you money over and over and over again? Okay, number 10, she says, get in the game early or the market can run away from you. She said when she started out, she actually missed the Manhattan market and had to wait for 3 years. But that taught her not to wait, to just get in and get in early. And this really resonates with me because the whole idea behind real estate investing is you have assets, and the assets get to the stage where you have a big enough portfolio that those assets are spinning off the cash flow that you need to be able to um, use that passive income to do things that perhaps replace what your active income was allowing you to do. Yeah, so, okay, let's continue. If I can get my phone to open. There we go. All right, oh yeah, number, make sure I got the right number. Yeah, number 11. She said when she said she actually had 85 agents working for her at one point for the Corcoran Group, yet she had to take a second gig as a messenger to make extra money. So this was humbling to hear. So clearly, this real estate game is one where you can be really asset rich, but cash flow poor. And if the cash flow isn't there, that's not a reason to get out of the game. It might be, to her point, and something Cardone preaches a lot, then if you're broke, then you find a way to make income. And you hold on to the assets because the assets will inevitably give you that money, but maybe cash flow is not really working out at the time. So, and to be humble enough to take a gig as a courier, more or less, like a messenger, right? Delivering messages. That's pretty cool. Shows her commitment to real estate. And no surprise of why she's so wealthy and on top of the game now. So she said she saw the penthouse she now lives in when she was a messenger. And she told the owner to call her if the owner ever wanted to sell. And it took 14 years, but 14 years later, the owner called her and she bought that penthouse for $10 million. Wow. That's a great story. I love that story. It shows perseverance, right? And it shows having vision, but also the perseverance and the patience to wait, and that good assets will always be good assets, or at least good for a long time. And then number 12, she says imagination and moving fast are competitive advantages. And she spoke a lot about ideas that came to her, for example, putting together a real estate report that she sent to the New York Times. So in fact, I'm going to jump to number 14 and come back to 13. So one of the ideas she had, so tip 14, she started a Corcoran report and sent it to the New York Times. And at that stage, her group only had 11 sales. Just imagine the gravitas, and not the gravitas, the chutzpah of like, I'm going to create a report about real estate in New York based on 11 sales. But she did it, and the New York Times put it in the front page of their real estate section. Not right away, but eventually. So this idea of starting quickly and executing is something that she lives by. And she killed me softly, y'all. Like, for those of us who have been highly educated or highly edumacated, as we jokingly would say, and work in professional settings where there's probably a lot of analysis paralysis. Well, let me speak for myself. I won't speak for y'all. Like, I overanalyze, right? And she's saying, no, don't overanalyze. In fact, she says, don't focus on not making a mistake. So guilty as charged. The overanalysis is like, don't want to make a mistake, don't want to look stupid, don't want to say something that's not quote unquote true. She says, she says, who knows if my numbers were accurate? She says, numbers got her notoriety. So she submitted and supplied these numbers to the New York Times, and this is what the public started taking note of and giving her a lot of credit for. So she says the reporters cared about sound bites, so she just kept churning out reports and building a name and a brand through marketing. And so this comes back to a lesson from Cardone again. Better known or best known beats best. So building a brand is important. That's why I'm so focused on understanding marketing better, y'all. Trying to get there. All right. And then going back to number 13, she says she advertised on billboards and took out full page ads in the New York Times. Okay, that actually flowed well because this is marketing at its best. So she invested in marketing and it paid off. So for those of us like me starting things like YouTube channels and other things, word to the wise, marketing pays. So invest in marketing. I intend to. I've already started, by the way. Okay, number 15, she says, in real estate, making mistakes won't lose you money. So get out there and act. Stop thinking that avoiding mistakes is how you win in real estate. I don't think that needs any further explanation. Okay, this one was an ouch because she's number 16. She says she always loses money with Harvard MBAs. Oh man, like having a Harvard MBA and yeah, so listening to that, I just thought to myself like, okay, so is it the way we are trained or is it just the way we think as Harvard MBAs that caused this, or is there something else going on? But okay, so continuing with that thought, she says, interestingly, her experience is that scrappy first generation immigrants are likely to make more money than Harvard MBAs in real estate. And number 17, she says you got to have blind faith. So if the numbers don't seem to justify it, now I'm interpreting, but you have a feeling or a sense that this is a good property to buy, jump in, have faith. Not quite what you would expect, right? But yeah, that's what she shared. And then number 18, she says she's not a marketing genius because they called her a marketing genius on the podcast, but she says, but she takes risks. And she says she remembers when interest rates were 18%. And insurance companies, she remembers a time when interest rates were 18%, and an insurance company approached her because they needed to sell 88 units, and they needed to sell all of them, right? And she initially looked at it and thought about it, and she says, no, it can't be done. And I might be mixing two things here, y'all, so just keep me honest. Like if you get a chance to go and watch this podcast on Bigger Pockets, and I've mixed these two things of 18% and the insurance company needing to sell 88 units, please just jump into the chat and let me know. And yeah, okay, so but let me just continue with what my notes are showing. So she says she met with the developer and insurance company, and then she told him that no, this thing can't be done. Like there's no way you can sell all 88 units, like, you know, in a short period of time. And the insurance company was trying to do this as an off-market sale because of the probably the brand damage that would have been done to them if it was known that they were selling these 88 units. And here she shares something that I believe very much happens, and it's happened a lot in my life, and that is connecting the dots, or connecting disparate dots or dots from different things and finding solutions that way, right? So not focusing so much on problems, but focusing on solutions when you're able to connect different dots. So what did she do? She said she was, and I forgot the story behind the puppy sale, but I think it was a family thing, and she got exposed to a puppy sale, and the puppy sale gave her an idea. And the idea was this: a one-day sale on a first come, first served basis. She priced all the apartments at the same price. And then she opened it up and said, go. So she made 1 million, y'all, in about 2 hours. Or she made close to a million because she gave the actual number and it wasn't exactly a million, but it was a lot. Right? In about 2 hours, she sold the 88 units at average sales price of $64,000. And then she talked about number 19, how she uses TikTok. And apparently she has a series called Get Ready With Me videos that have been viewed over 1 million times. So I haven't seen them, but it does make me think that TikTok is an absolute must as I'm building out my YouTube channel and building out my brand. And for those of you who are new to the game like me, sounds like TikTok is a must. So here's a veteran using TikTok. Number 20, she says, refi is a way to get rich with real estate. So never sell, just keep refinancing. So that unit that she shared already, the story about refinancing 10 times, that makes total sense. Number 21, she says, numbers should not be relied on when you want to buy and hold. Says the first year, the number will actually make you feel like she says like in the first year the numbers tend to be bad, especially if you're leveraged. So if that's what you pay attention to, it's not going to help. But if you're planning to hold it forever, then don't pay any attention to the numbers in the first few years. And then last tip that she gave was number 22. She says, if you're risk averse, get out of the game. You can't make money in real estate if you're scared or if you're risk averse. So I really appreciated this particular tip because it's easy to be scared and to feel like, wow, like I don't know, like if I take this risk, like what if it doesn't work out? I recall when Winnie and I were having a conversation about buying Romney Park 205, and we bought it because we had a very clear plan in mind. So it was a go slow plan, buy one unit at a time. And then the opportunity to buy 9 units at the Romney Park came up. I was really excited by the idea, but it was also scary at the time. And eventually we didn't end up being able to buy those 9. But what she's basically saying is that that's a lesson that I will definitely keep, because part of not being able to buy 9 was the risk aversion. So if you're going to be in this game and you're going to be successful, can't be risk averse. So don't, at least my training tells me, like don't not consider the risk. But she's saying that in real estate, risk is something that over the long haul, especially if you're buying to hold, risk is not something that's going to be an issue. And in her career so far, she seemed to have proven that. And then she just shared a couple of closing thoughts, or I think maybe this is my synopsis or summary of closing thoughts from her podcast on Bigger Pockets. So she says, appreciation is king. So this is opposite from what I've been hearing as I've been learning about the real estate game. And this might be a unique thing that's happening in this period in time, like maybe since 2008 when the market crashed, where cash flow has been king, interest rates were low, so therefore the debt servicing on real estate was low enough where properties would cash flow. And she's saying, no, that's not what the focus should be on. Focus on appreciation. And especially given her strategy of buying in up and coming areas, I can understand that, because if you buy in an up and coming area, then most likely the appreciation is going to be sick. You're going to be making double digits appreciation probably each year, right? Especially if in a growing market. So she says cash flow pales to appreciation, in comparison to appreciation. And finally, she says when it comes to equity, she always thinks of the equity that she has and she builds up in her properties as the funding for the next deal. So there you go, y'all. Those are Barbara Corcoran's formula for real estate investing, lessons from the Bigger Pockets podcast. I hope you found this video to be useful. If you did, wouldn't you please give it a like? And if you like the content that I'm covering on this channel, won't you please subscribe? And if you want to share what I shared in this video with folks who you think would benefit from that, won't you please press the share button? And then last but not least, if you want to know about new videos when I make and release them, please click the bell button. All right, y'all. See you soon.